So, Lindsey, what picture are you getting from the markets as it relates to the economy?
Well, I think the market's very concerned at this point. There's a lot of different variables that are putting pressure on the market, and they mainly seem to be to the downside. We're continuing, as you alluded to, seeing very ample levels of uncertainty, instability from Washington. And of course, the fundamentals of the U.S. economy are pointing to a significant slowdown as we turn the corner into 2019 with the backdrop of a Fed that seems very focused on the fear of inflation, forcing their hand for additional rate increases at a time when the economy may not be able to withstand a further backup in rates. So I think there is a lot of pressure on the market right now that will continue to cause ample volatility as we look out to the new year.
What kind of a slowdown, Stephen, are we looking at?
Well, I agree with Lindsey completely, at least from our clients at Beacon on the buy side. They're clearly focused more on the buy side risk, and it just doesn't help out of Washington that as investors are craving stability and consistency from the administration, that we keep getting interjections of volatility.
You think that's going to have an economic impact, even on the jobs data, Lindsey, as we go into 2019 with the government shutdown?
Well, I think it's going to certainly weigh on some of the softer data points that we see for the economy. It's going to impact consumer confidence, business confidence, and it may add a little bit of volatility here or there in terms of the jobs picture. But of course, we don't want to focus on one data point to get a sense of what's happening out in the labor market. We look at this more of a longer-term trend, which certainly businesses have begun to pull back in terms of their monthly hires. Now, still positive at this point. We're still putting Americans back to work on a month-to-month basis, but this may compound that downward pressure and certainly compound as we anticipate that downward pressure on wages as well, which really has been the missing component for the consumer in this recovery.
Stephen, it's interesting because it seems like a bit of an eye of the beholder issue going into next year. You could see 2 to 2.5% U.S. GDP growth, 10-year treasuries at 2.75%. Corporate profits may be up single digits as kind of a Goldilocks environment, yet it's the same exact environment that I think some investors are sort of panicking over as marking too much slowdown. What do you think is going to make the determination as to how that kind of a year, if we get it, is going to be received?
I think one of the big problems is coming out of Washington is that as investors, at least through the first 2 years, assume that President Trump ultimately was bounded by his fixation on the market performance. But what they're also seeing is that while he has this pull towards making sure that the bottom doesn't fall out of the markets, he also has this pull towards the most ardent nationalist protectionist element of his base, and he keeps playing to it because that's what his political strategy is. So a lot of the volatility is being driven by this hope that he'll finally not go too far because of the concerns about the market, but then they see things like the shutdown, threats like this morning about closing down the southern border, concerns about China trade. So no matter what the rhetoric is, he has such a mercurial temperament that they're just concerned at any moment he could pull the rug out from under them. And I think until they see some normality out of Washington, they're concerned that there's really no safe point.
Lindsey, we just got another look at the housing market with pending home sales and got another big drop after economists were expecting a gain. One of the biggest debates on the economy this year has been, is housing some sort of leading indicator, canary in the coal mine, like it has been in the past for the broader economy? Where do you stand?
Oh, absolutely. Housing may not be the large net drag on the economy or the leader of the economy as it once was prior to the financial crisis, but housing still is a very good gauge of the overall economic health of the U.S. economy. It leads lending, it leads construction, and it leads in good part consumer confidence. We all feel wealthier when the value of our underlying home is appreciating. So when we look at the housing market and we start to see bubbling weakness underneath the surface, now as you mentioned, pending home sales missing, but we've also seen outright sales, existing and new home sales, both disappointing in the last couple of months, with slower construction activity as well, at least on a trend basis. So this does speak to the notion that the U.S. economy is beginning to slow, and Remember, this is one of the most interest rate sensitive sectors of the economy. So we would expect housing to begin to show signs of weakness first and foremost as the Fed begins to breach the end of this tightening cycle. So absolutely, this is a very big red flag, and we would expect, again, this weakness to filter out into some of the other key sectors of the economy as we move into 2019.